How does a collar option strategy compare to other hedging strategies? Have you ever wondered how different hedging strategies stack up against each other? Today, we are going to take a closer look at the collar option strategy and see how it compares to other methods. The collar option strategy is a risk management technique that combines holding a long stock position with buying a protective put option and selling a covered call option. This combination creates a protective collar around your investment, limiting both potential losses and gains. One of the standout features of the collar strategy is its defined risk and reward range. The put option sets a floor, which limits your losses, while the call option sets a ceiling, capping your gains. This is different from just buying protective puts, which allow for unlimited upside but come at a higher cost. On the other hand, selling covered calls generates income but leaves you exposed to downside risk. The collar strategy strikes a balance between these two approaches. Cost efficiency is another key aspect of the collar strategy. When you sell the call option, you collect a premium that can offset the cost of purchasing the put option. This means you can often implement a collar at little to no net cost. In contrast, buying puts outright requires paying the full premium, making it a more expensive option. The collar strategy is particularly suitable for investors holding significant shares of a stock. If you want to protect against short-term downside risk without selling your shares, the collar is a great choice. Other strategies, like outright selling or using stop-loss orders, might force you to realize losses or miss out on future gains. The collar allows you to maintain ownership while managing risk effectively. However, it is important to note that the collar strategy does come with a trade-off. While it provides downside protection, it also limits your upside potential due to the sold call. This is a key consideration when choosing your hedging strategy, especially compared to more aggressive hedges that do not cap profits. Flexibility is another advantage of the collar strategy. Investors can customize their collar by selecting specific strike prices and expiration dates. This allows you to balance the level of protection, cost, and upside limitation according to your individual needs. While other option-based hedges offer some flexibility, the collar uniquely combines both a put and a call. When comparing the collar strategy to other common hedging methods, the differences become clear. A protective put offers unlimited upside but at a higher cost, while a covered call generates income but lacks downside protection. Stop-loss orders can automatically sell your stock at a set price but do not provide upside protection or income. Portfolio diversification reduces risk but does not offer explicit downside protection on a specific stock position like a collar does. In practical terms, the collar strategy is favored by investors looking to protect gains or limit losses during uncertain or sideways markets. It is a conservative hedge that balances cost and protection, making it a popular choice for those managing concentrated equity holdings. By using the collar option strategy, you can define your risk boundaries while still participating in potential gains.